All right, let's jump right into this explainer. Today, we're unpacking a really dense, anonymous expert report all about the multi-layered mechanics of global taxation and cross-border business structuring. And listen, we're not just going to skim the surface here. We're diving deep into the core ideas, those hidden cause and effect relationships, and the actual actionable insights that you need to grasp this at an expert level. So no fluff, just pure structured analysis. To keep us on track, we'll map this out using a cause and effect matrix. We're going to cover 1. US business structuring advantages, 2. The global taxation mechanism, 3. Qualifying for tax credits, 4. Tax treaties and limitations, 5. Cross-border withholding rules, and finally, 6. Resolving systemic tax disputes. Let's get into it. Section 1, US business structuring advantages. We need to start by setting the baseline, looking at exactly how your initial corporate structure inherently dictates your foundational tax liabilities right from day one. So here's a provocative question for you. How on earth does a US entity operate as a tax haven? I know, it sounds totally counterintuitive, right? It challenges this implicit assumption we all have that incorporating in a major, highly regulated jurisdiction automatically slaps you with heavy domestic taxes. But the non-obvious reality, and this is a key takeaway from the expert report, is that jurisdiction alone doesn't actually create the tax burden. Operational presence does. If your home country doesn't enforce global taxation, setting up a corporate structure in a foreign jurisdiction can paradoxically be an incredibly efficient tax haven. If you're building an international business, this is literally the foundational assumption you've got to rethink. This perfectly illustrates the binary choice at the very heart of corporate structuring. On one side, holding companies with zero local operations often completely bypass domestic taxation. We're talking informational returns only, and that's it. But on the flip side, we have ECI, effectively connected income. The literal second you open a physical office, run local operations, or provide services inside that jurisdiction, boom, you generate ECI. And that flips a massive switch. It instantly triggers full tax compliance and domestic tax rates. So you see, it's a strict cause and effect relationship based entirely on where the operational energy of the business is actually being spent. Moving on to Section 2. The global taxation mechanism. Now we transition it into the foundational rules that trigger double taxation for individuals and operational entities. This is where the math really starts to get complicated. Okay, so the absolutely crucial point here is that for citizens and resident aliens of jurisdictions with global taxation, simply earning revenue abroad does not cut your tax ties to your home jurisdiction. The expert report makes a point to emphasize that this system is actually somewhat unique globally. It operates on this implicit assumption that the quote-unquote privilege of citizenship or residency comes with a non-negotiable financial obligation permanently attached to your global economic footprint. It's basically a heavy tether that follows you everywhere you go across the map, making sure that crossing a border absolutely does not leave your tax liability behind. Expert analysis tells us that global taxation isn't just about income. It dictates some seriously strict reporting obligations across borders. For example, non-residents face heavy restrictions. They are taxed strictly on their effectively connected income. Meanwhile, any unconnected, passive income gets immediately hit with a flat statutory withholding rate. Plus, dual status individuals deal with severe filing restrictions. And get this, domestic employers are often on the hook to pay employment taxes on behalf of citizens working for their foreign subsidiaries, assuming certain ownership thresholds are met. The cause and effect is crystal clear. Structural ownership across borders directly imports tax liabilities right back to the parent entity. Which brings us to Section 3, qualifying for tax credits. Because to mitigate the heavy mathematical burden of this global taxation, we really have to deeply analyze the primary relief mechanism. Enter the foreign tax credit. Let's break down how this actually works, because this fractional formula proves a fundamental unwavering rule. A home country is never, ever going to subsidize a foreign jurisdiction's higher tax rate. Imagine your foreign income makes up exactly 10% of your total worldwide income. By law, you can only offset a maximum of 10% of your domestic tax liability, which in this specific scenario is $2,000. Even if you actually paid $4,000 to that foreign government, your home jurisdiction hard caps your relief. You just have to absorb that loss. It's a rigid mathematical ceiling, completely designed to protect the domestic tax base from being eroded by higher foreign rates. But hold on, before you can claim a single dollar of that credit, the foreign levy has to survive 4 incredibly strict tests. It must be imposed directly on you. It has to be paid or accrued by you. It must represent an actual legal liability, and crucially, this is step 4, it cannot provide a specific economic benefit. If you pay a foreign fee and you get goods, property, or services in return, well, that's a transaction, not a compulsory tax. The implicit rule we're seeing here is that only true, unreciprocated wealth extractions by a foreign government actually qualify for relief. Now, let's look at a totally non-obvious detail regarding accounting methods. Most individuals just default to the paid method, meaning they claim the credit when the cash literally leaves their hands. You can choose to elect the accrual method instead, claiming it when the liability is fixed. But the massive analytical insight here is a hidden trapdoor. Switching from the paid method to the accrual method is only allowed under an extremely narrow first-time amended return exception. If you miss that tiny window, you are locked in forever. It is a procedural absolute that catches so many people off guard. Let's push forward to Section 4, Tax Treaties and Limitations. Next, we're going to examine exactly how international treaties step in to override those standard mathematical formulas and statutory rates. This expert insight right here reveals a massive hidden compliance trap. Let's say a foreign country's standard tax rate is 20%, but a tax treaty specifically caps it at 15%. If that foreign entity accidentally withholds 20%, you absolutely cannot claim that full 20% as a foreign tax credit back home. Why? Because under the law, your actual and legal tax liability was only 15%. That extra 5%, the authorities view that as a voluntary overpayment. The home tax authority forces the burden of proof and the burden of recovery entirely onto your shoulders. It's a huge compliance trap you definitely need to watch out for. And it gets harsher. If you fail to formally invoke a tax treaty, withholding agents will automatically apply this incredibly aggressive default statutory withholding rate on your cross-border passive income. 30%. Yep, 30%. It is an immediate, heavy financial penalty for simple administrative non-compliance. The system essentially assumes maximum liability right out of the gate until you formally prove otherwise with the proper treaty documentation. All right, Section 5, Cross-Border Withholding Rules. Let's look at the systemic enforcement mechanisms that ensure these taxes are actually collected globally. Like, how do governments genuinely enforce this stuff? Well, they do it by drafting third parties to act as their proxies. Tax authorities rely on strict cause and effect regulations to force foreign financial institutions into identifying asset ownership. If a foreign bank or entity fails to comply with these global reporting mandates, they are threatened with massive withholding penalties on their very own income streams. This effectively deputizes the entire global banking system, turning it into a massive enforcement arm for domestic tax authorities. Pretty wild when you think about it. Using a stripped-down hypothetical of $1,000 in passive income, we can see the exact mathematical results of that treaty trap we discussed a minute ago. If $150 is withheld abroad, but the treaty limit is only $100, the home country credits you exactly $100. That leaves a $50 overpayment. And the policy reason behind this is actually brilliant in its cold logic. If they just allowed you to credit that extra $50, you'd have absolutely zero incentive to fight foreign governments over improper withholding. It's specifically designed to prevent an improper wealth transfer between nations. Which leads us perfectly into Section 6, Resolving Systemic Tax Disputes. So what is the actionable solution when the international tax math goes wrong? and you're the one overcharged that $50. You basically have to fight for a redetermination. But remember, taxpayers bear the burden of proof here. You have to demonstrate that you exhausted all practical administrative remedies with the foreign government before bringing the issue back home. However, the expert report does note a highly pragmatic caveat. This exhaustion of remedies actually has to be practically cost efficient. You're expected to take a reasonable business approach, weighing the out-of-pocket costs versus the benefits. If fighting for a $5 overpayment is going to cost you thousands in legal fees, the authorities do recognize the impracticality of that. But the baseline requirement always remains that you must actively attempt to reduce your foreign liability first. And we're going to leave you with this final, provocative thought. As compliance technologies rapidly advance, as global reporting mandates effectively deputize the world's financial institutions, and as international treaties continuously tighten, the room to maneuver is shrinking fast. So, how long until the traditional concept of a tax haven is entirely engineered out of existence by sheer, brute force systemic enforcement? It's definitely something every cross-border entity needs to deeply consider as they structure for the future. Thank you for exploring this anonymous expert report with me on today's Explainer. We'll catch you next time.